Okay, good morning. How are you? Oops. There we go, a little better. All right. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of reducing our risk, increasing our consistency, and let the money take care of itself over time. With that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne. Nice to meet you. Let me know how it can help. Kind of look like a vampire. Let me know how it can help. Technical analysis, fundamental analysis. I've been doing this for 20 years. I've learned a few things. Not everything, but a few things. And I'm here to share. I'm your guide on this thing we call Forex. So, I suppose, be the squeaky wheel. Let me know how I can help. That is what I am here to do. This is our hour of power. So, I'm sure we'll do gold and oil and Bitcoin. We'll do dollar pairs, maybe some exotics, maybe this, maybe that, whatever. Truckin' says, hey, I'm a newbie, so everything helps out. Sweet. Good. We were all newbies once. Not Raymond, though. Raymond's an old soul. So anyways, let me know how it can help. If I don't cover it today, subscribe so I can cover it during the next stream. Next stream is not tomorrow. The next stream is not Thursday. The next stream is not Friday. Because we're rolling into holidays in the United States of America. For some reason, they celebrate Thanksgiving now, which is about a month and a half late. Well, no, about a month late. But whatever, for whatever reason, it's the American Harvest Festival. And there are harvest festivals all around the world, and this is where you give thanks for the bounty that nature has given you, and also a time to give thanks to your friends, your families, and your loved ones. So that's what we're going to do for the next several days. So hey, if you're in my day trading group or my swing trading group, remember today at 2 p.m. you will be meeting with Ryan for the stop, look, and correct session. Okay, but there will not be a 4 p.m. day trading because I don't want to set up a day trade into a dead session for tomorrow, right? So it doesn't make sense. If you look at the description below today's video, you will find a link to my book, Strategic and Tactical Forex Trading. You will find a link to a free training course on the FX Bootcamp YouTube channel. You will find a link to fxbootcamp.com, where there's at least 65 hours, at least. I'm told it's closer to 88. But anyway, 65 hours of training videos, minimum, for $88 a year. So that's another great way to get help. And it's not fluff, I'm telling you. It's not just a ton of videos for the sake of a ton of videos. Each video is on average an hour long. Okay? It's hardcore. $88 a year. That's definitely a resource for you. And there's also a link to tradersway.com. Hey, do you want an ECN? You want to trade with an ECN? Tradersway.com. You don't want to click the link? You're like, Wayne, I don't want to be tracked. Don't worry, I'm not tracking you. There's no cookie. There's no pixel. Nothing I put on there. I just typed it in. But if you're worried about that, don't worry. Don't click it. Just type it yourself. Go in incognito mode if you want. Tradersway.com. Okay? Go check it out. I think you'll be happy. Okay, so here we are. I guess we're doing commodities. Look at that day yesterday, huh? Holy smokes. Look at that volume and volatility, huh? Well, Brent and WTI have been falling for very, very logical reasons. Oops, wrong one. Oh yeah, I changed the template. They've been falling for very logical reasons. And over the weekend, we found out, lots of different things. Like, I guess over the last week or so, we found out that China is going into lockdown again. China has cut orders from Saudi Arabia for oil. The United States is now going into probably a recession and a bunch of other things. Okay. Arash says, hey, Wayne, what do you think about online prop firms? I don't believe in them at all. So, hey, if you're an online prop firm and you want me to recommend you, you should prove to me that you're a real prop firm. But I don't believe in them because the business model doesn't make any sense. If you just think about it, where do they get their money and why would people invest? And you'll find out it doesn't make any sense. So I don't know every prop firm, but my guess is probably 9 out of 10 of them are preying on poor people, luring them in with the potential promise, the promise of potential richness and greatness. Oh, we will give you money for free and you can keep most of the profits. In fact, keep all the profits. Oh, but you have to pay for this, and oh, you have to pay for that, and then there's this test, and then you fail the test, and then you got to take this other thing, and that's going to cost you money. And you're like, wait, the business model is not set up. You got to start with logic, and I haven't seen one that has a logical business model that says we're actually a prop firm. Okay, like, for example, no one's going to give you 80 or 90% of the profits unless they can prove to you that there's a model of success down the road. Oh, yes, Lucas, you're right. Yeah, I will be back on Sunday. Yeah. Well, it's not me. I'm not going away. The markets are closed. Dude, okay, let's talk about this for a second. It's not that it's a holiday weekend. It's not that some people travel in America, all that kind of stuff. It's not that the banks are closed. It's not that the markets are closed. It's everything. So if you're like, well, I'm in my winter home in Croatia and I don't have Thanksgiving here, Wayne, so I'm just going to trade normal. No. Think about it. Banks in the United States will be closed. Markets. On Friday, some markets will be closed. Some markets will be open only a half a day. There's no real traders trading. It's Wednesday, right? Or is it Thursday? Thursday, all the markets in the United States are closed. There's no big shots. There's no big firms. There's no central banks. There's no commercial banks. Nobody is going to be trading except retail traders that have no idea what they're doing. Trading against other retail traders that have no idea what they're doing. And the end result will probably be a mess, a disaster. So my message to you isn't like, oh, well, some Americans are going to go away and spend time with their family. You should not trade. That's why I'm not doing a day trading group tonight. Okay? Because setting up a trade for tomorrow would be dumb if the vast majority of professional traders won't be there in the market. Okay? So take some time off. Sharpen your saw. Go back through the training courses. Read a book. Donate, visit a museum. Okay? Like, so that's what you should be doing with your time. If you lose money on Wednesday, Thursday, and Friday, it's just flat out dumb. How many people here want to lose money, and meanwhile the whole world is pointing their finger at them saying, aha, you're dumb. If you don't want that, then invest your time somewhere else. Yeah, Jim's like, me. Hey, right? Hey, if you don't know what the answer is, don't ask the question. Right? If you know Glenn Ross, right? If you don't know the shot, keep your mouth shut. Anyways, so my WTI down. We hit a line in the sand that we identified many weeks ago. And it appears to me that at that exact price, and by the way, I drew this before the green candle. I drew it I drew this a week and a half ago. I drew this line here. Came down, hit it, up, just like that. So what's going on there? Clearly, bears had orders to exit for profit, and bulls had orders to enter. And that's what happened. Yeah, no, right. No, I understood that, Lucas. Yeah, you're good. Yeah, no. Okay. Hey, Arash, I'll tell you what. I'll give you all the money and you can keep all the profits. Does that sound right? Imagine you approached an investor. Hey, investor, I'm very good at trading Forex. So I have a proposition for you. Why don't you give me a whole bunch of money and I'll keep all the profits? But if I lose money, you keep all the losses. What do you think? Do you want to sign up? I keep 100% of the wins, you keep 100% of the losses, and we'll call it a long-term valuable relationship. What do you think, Arashaman? Do you think you can get somebody to sign up? James, it depends if you're in a position trade or a day trade. So a day trade, yes. Position trade, no. How about this? Anybody answer the question? I'm still addressing this idea of a prop firm. Everybody here, please answer this question. Do you think it would work if you approached a wealthy individual? Okay? And you say, give me the money. You keep 100% of the losses. I keep 100% of the wins. Well, prop firms do, but I think they're misusing the word prop firm, a proprietary trading firm. Okay? Yeah. So look, okay, let's change it then. Okay, Mr. Investor, you're rich and powerful. I will give you 20% of the profits and 100% of the losses. Do you think they'll sign up for that? No. Mubarak, right? Unless they're a charity organization, right? Uh-huh. Now, Hope says no idea what a proprietary firm is. Now, typically, historically, I'd say, what happens is you got someone at a hedge fund that has made so much money that they've decided they don't want to work for clients anymore. So they grew their, and by the way, I'll step back here. You got me into a longer question, but okay. Okay, this is how it usually works. Okay, your money, you're the hedge fund manager. Hedge fund man. Okay, and you start a hedge fund, and then you have client money. Okay, and it's way bigger than yours. Okay, and you get to keep 20% of the profits out of this. So when a prop firm says you can keep 80 to 100% of the profits, it's right off the bat bullshit. Okay, I mean, dude, it doesn't make any sense. No investor would sign up for that. But anyways, let's go, okay? So this is a typical hedge fund structure. Plus you get to keep 2% for management fee to pay the rent, to pay the compliance person, to pay for the legal work, to pay for the audits. Okay, so you get, okay, the client pulls 2% out a year, and that goes to the firm. Okay, so now you got the firm. And this is, the firm is a drawdown. So the money just goes to here, and that pays the phone bill, right? 20% goes to where? Okay, expenses, like your salary, the hedge fund manager's salary, for example. So the 20% goes there. But let's say you raise a $10 million fund, okay, and you have $1 million of your own money. Okay. Oh, so I have a question here. How are they scamming? Well, I don't know. If their business model doesn't make any sense, I don't know. How was FTX scamming? They were giving fake numbers and stealing the money. You know, like, I don't know, but if it doesn't make sense, it doesn't make sense. But look, if who are you using? What, I can't even, FTMO. Look, if they're legit, they should contact me and I'll recommend them. Okay, but whatever. So let's get back to this. So what's a prop firm? Okay, so over let's say 10 years, you grow this account slowly to 100 million. Meanwhile, you lived off the salary. The firm, the actual like company, lived off the 2%. So year after year after year, the 20% went to salaries. So your salary depends on what you're growing. So look, going from 10 million to 100 million in 10 years is okay, very, very realistic. We're only talking about probably 8% annual growth. So let's just say over a period of time, you grow to 10%, but you got your money in here too. But you get to keep 100% of your money, and you're living off the 20%. Okay? So this is the internal fund. And very often, if your hedge fund has multiple traders and employees, you're like, look, put your money into the internal fund that is traded and managed by the firm, separate from the client money, but exactly the same trades as the client money. So in 10 years, okay, this is now 10 million. And you get to keep 100% of the 10 million, right? And so let's say another 10 years goes by. Now this is 30 million. Okay? You see, at some point, there's so much stress of doing all the work and only keeping 20% of the money, then you change it to a proprietary firm. And you're like, we don't have client money. We only have our internal money now. Okay? In which you might take, 20% out to pay everybody and the other 80 gets reinvested. So, 5 years later, this is 100 million, right? Because you're growing faster because you're saving faster. And now you're making so much more money. So the way to look at it is the way that a proprietary firm trades its own money. It's kind of like a family office. Okay. Now, family offices over the years were, let's say 15, 20 years ago, were restricted on the types of things that they could invest in. And that's opened up so more and more. So it's kind of a family office. But the way it actually would work is a family office would find the original hedge fund and invest into the hedge fund. And then the proprietary firm at some point would get big and then drop these guys because A, the compliance is terrible, B, the stress is terrible, and C, you're only getting 20%. And if your internal fund gets big enough, you could just keep making the same amount of money with a lot less stress, no reporting. Okay? Right? So that when I see these firms, though, I don't see that. There are firms, and most of them are in like Chicago, for example, because many proprietary firms had hedge fund-like strategies using futures and options that unaccredited investors were just not able to access. They were only accredited investors and institutions could invest into strategies like that based on the laws. And most of those opportunities had to do with futures and options. So those proprietary firms usually were in Chicago. And it's a proprietary firm where they hire you, give you a salary. You come to their office, you sit at their desk. They have managers, they have departments, they have staff. That's what a proprietary firm would look like. But if they're like, hey, we'll give you $100,000, but you got to pass this test, and to take the test, you got to pay money. No, I'm sorry. That's something different. Okay, that's something different. What is it? I'm not here to say. But if I'm wrong and one of these prop firms is listening and they're like, no, Wayne, we're the real deal. And we want you to recommend us and send people our way because we got money and we're legit. If somebody could prove that to me, I would be happy because I know many of you are looking for that type of opportunity. Good. I'd be happy to make a recommendation like that. But right now, I've never seen a business model that even makes sense. You got to understand, I'm an old venture capitalist. So if the math doesn't look good on the model, where they're like, here's the model, and the model doesn't make sense, then it's just bullshit. And they're like, well, how do they scam that? I don't know, and I don't even care. Who cares? It doesn't make any logical sense, so I'm not fooled by the desire of driving a yellow Lamborghini. Right? Or getting out of poverty, and this is my only way. They'll give me free money and I can keep all them profits. I'm not that desperate yet. But to someone that needs an opportunity, that sounds great. But they're clouded with the necessity or, it has to make sense to somebody signing up for that. Now, again, if I'm wrong, hey, I don't mean to be a biatch. Maybe some of you guys are like, man, Wayne, I'm making $5,000 a month trading at some prop firm and it's great. Oh, okay. You're making 5, 10, 15, 20 grand a month from a prop firm? Wow. Okay, I stand corrected. Let me know. Send me an email, wayne@fxbootcamp.com. Richard says, from what I've seen, prop firms don't even teach. Why should they? Here's how a hedge fund would work. My hedge fund is looking for experienced foreign exchange traders with a track record of success. It doesn't say, our hedge fund is looking for experienced Forex traders, so we're going to just have you make a whole bunch of trades, and then we'll see if you're profitable, and if you are, we'll give you more money. It just doesn't work that way. It'd be easy. Look, you want to trade money? Right? Look, this is how easy it is. You want to trade money? Show me a 3-year track record of consistent returns and low volatility. I want a Sharpe ratio of 1.8 or 1.5, let's say. Yeah, 1.5 Sharpe ratio over the course of the last 3 years. I want to see how you reacted to the market pre-COVID, then when COVID hit, the rally after COVID with the free money, and then the secondary lockdown of China, and then where we are today. And then I would like to interview you about your thoughts about the market today and now and into the near future. And then I would like to interview you about where you think global markets will be in 2 years. That would be the basic first interview. You bring an audited 3-year track record, a minimum Sharpe ratio of 1.5, and then I'll talk to you about now, the near future, and the further out future as a first interview. And you're like, Wayne, I can't do any of that. Well, then you're not hired. It's like reality. Who the hell would hire you? I got $100 million and I'm willing to hire anybody and see if they're successful. Gee whiz. There's no way you would do that. Right? Just think of it. A hedge fund wouldn't do it, so why would a prop firm do it? They're not a prop firm. And again, if I'm wrong, help me understand, and I'm willing to listen. All it is I don't understand the business model, and I admit that's possible. Okay? Now, I've helped a few traders here. I've helped a few traders here. Sprinkle a little love. But what's the point of that? I want them to make money. I want them to make a lot of money and save it all. And now they can afford to be in a fund. Okay? There's also other logical, normal things. For example, I was asked recently, 2 years ago, I was asked to be a part of a new venture capital firm in the Silicon Valley. They were trying to recruit me to come back to the Silicon Valley, give up Forex, and be a venture capitalist again. Okay, great. A general partner. Yeah, cool. Yeah, not an analyst. Yeah, general partner. I'm like, cool. And I got the contract. I read it. I actually understand the legal contract, right? And guess what? It's required, and this is totally normal, because of the size of the fund that we were going to raise. My contribution as a general partner would be $2 million. Because when you go to a limited partner, like some sort of institutional investor, an insurance company, a corporate venture fund, that kind of stuff, and you pitch them, and we're like, yeah, we're going to raise, I'll make up a number. Yeah, $200 million. It's for seed investing, first round angel, post angel kind of stuff. So it's only $200 million, and we're looking for limited partners. And they're like, well, we have rules. The rules that a limited partner would probably have is that they can't be more than 10% of the fund. Otherwise, it's just their own fund. It's their own money, right? So they're like, look, we can't put in more than 10%. So the most we can put in is 20 million. And your firm's not big enough because our minimum is 50. So we have to pass. Oh, so you go to the next firm and they say the same thing. Yes, we're interested, and the maximum we can put in is 10%. So the most we can put in is 20 million. Excuse me. Of that 20 million, the next mandate is that the general partners have to have 10% of their own cash of the 10% of that investment. Okay? Or 1% of the total raised. Excuse me. And it's usually of the total raised. So a $200 million fund probably would require each general partner to have $2 million of their own money in the fund, because everyone's got to have skin in the game. You understand? Like, it's logical. The institutional investor says, look, okay, let's say there's a consortium of investors and they're like, okay, together we will give you the 200 million. But you got to have at least 2 million of your own cash in this deal. Otherwise, we're carrying all the risk. And you have nothing to lose. And as a way to mitigate the risk, you got to have a significant amount of your net worth in the deal. And that's true of every venture capital fund ever formed in the history of the world. And I even met with venture capitalists in South Korea. Okay? Okay? Same thing there. I met with one in Japan as well. But anyways, look, this is just how it works. There's nobody that's going to give you money if you A, got no track record, B, you don't have any formal experience, right? I guess that's what the track record is. Usually like a level of requirement and experience. So you're like, well, I have a master's degree in financial management, a macroeconomics degree from Harvard, right? I have 20 years of experience and here's my track record. Okay, that gets you the first step. But if you go and you're like, I don't have a formal education. Well, how do I know you know? I don't have 20 years of experience. How much experience do you have? 2 or 3. Then the next thing, you're like, I don't have a track record or an audited track record, either way. Okay. And then lastly, you say, well, I don't have any money either. Okay, you're successful and you want me to invest, but you have no money, no track record, no formal education. And then what? Why am I investing? Like, it's mind-boggling that people would follow a model that just doesn't make sense. So again, if I'm wrong, I apologize. I didn't wake up in the morning to say, hey, I'm going to poo-poo on prop firms. It's just clearly I don't understand. Okay? Okay? Cool. Now, if that makes sense to you, that if I was going to be a general partner at a venture fund, and I would be required to put in $2 million because there's no investor in the world that's going to invest into our fund if the general partners have no skin in the game. If that makes sense to you, then maybe I've just given you an aha moment. Maybe you didn't know that that's how venture funds work. That's the structure, the legal structure, because investors want to lower their risk. So giving a bunch of amateurs money and then allowing them to keep all the profits for free, but meanwhile shouldering all the losses, how does that make any sense? And that's not how prop firms work. So okay. Anyways, BioMine WTI. Sorry for the diatribe. Hey, you brought it up. Okay. All right. Let's take a look here. We're having a challenge here with gold. Now on the hourly, you can see that there's a short-term short possible, one more short-term short, and then possible another move higher. Hey, did you click the thumbs up button? At least maybe you learned something, or maybe you're just like, man, he bitches too much. Well, look, somebody asked. So here we are. You can see there could be one more leg down and then an up. Okay. Cool beans, you see. Maybe a down and then an up. Okay, maybe. There's the big reversal of Brent. We looked at that. Let's zoom in. We got to zoom in now. Zoom. And a boom. Kicking off the bottom. Desperate Hail Mary here. The thing is, if you wanted to be a bull, okay, if you wanted to be a bull, you're going to look at this bottom area as your buy. Okay. And so your trade is based on something like this. If you wanted to be a bull. Now, this is the critical bottom. Notice that we hit the weekly and monthly pivots and it stopped instantly. David says, hey, Wayne, I trade the hourly with 5 minute entries. Great. But we have an inside day. Yeah, it tells you to stop trading. What does an inside day mean? There's no trend. So you can use range bound as a strategy, but I want you to think about this, David. You've discovered an inside trading day on a holiday week, but it's screaming that nobody is trading. So I would walk away. So we can go take a look at pound, for example. Why not? So I discussed this yesterday, by the way. Yesterday, I talked about the inside trading day. Okay. Oops, I should do it this way. Low, okay, high, and then we're inside that. Okay. And, well, look, okay, we're between the 55 and 21. If you believe the 55 is in control, and that's subjective, then you are going to set this up like this. If you believe the 21 is maintained control, and you could try to argue it in here, then you think this. The way I teach, okay, you want a free lesson here? This is what I teach boot campers. First thing you do, okay, is you identify this as a top. You identify this as a bottom. And you let it break. And you would sell here or buy there. Okay, and let the fools figure it out in here. Okay. Hope says, yeah, or you can sit around and scalp this stuff. And so I would roll this over like this. Okay, and you can play around with it that way. Okay, so you got this in play. If you add a little bit more time, there we go. I would have this marked out, of course, as a scalper. Okay. So as a scalper now, you would be anticipating, let's clear that out. You'd be anticipating this now. Okay. Well, David says he tries to only trade hourly, buy and sell zones. Well, I'd ask why. Why would you limit yourself to that? That doesn't give you a big view, right? But also choppy. We're in a dead week and you got a dead day. And you wonder why it's choppy. So what I tell boot campers all the time is in periods of low volume, technical analysis is less reliable. You can't have a self-fulfilling prophecy if nobody's trading. So you get odd behavior. You get entries but no follow-throughs. Or you get bounces that bounce into a collapse and you're like, why did that happen? The market's thin. Nobody's trading. How could a retail trader be successful if other traders are not trading? It's just terrible. It's terrible market conditions. Okay? I would argue that if institutional investors are considered smart money and they're not trading, is it smart to be trading? No. So, yeah, pound dollar's a little choppy on a holiday week. Really? And of course, I'm being facetious. Of course it's choppy. You're trading it and nobody else is. Just a bunch of retail traders, huh? Hedge fund managers jumped on a private jet and they flew to the Caribbean with beautiful people much too young. With people that are much too young, much too beautiful, and they're flying to the Caribbean, and all the retail traders are sitting around short selling pound dollar still. And yeah, so anyways, how can you tell about volatility? Okay, well, one, it would make sense that less traders are trading on a holiday week with markets closed and banks closed. Makes sense. Two, an inside day shows you nobody's trading. So let's say, look at yesterday. It never made a higher high. It never made a lower low. Nothing happened. Except retail traders stepping on each other's feet. Okay? Otherwise, we'd have a trend. Now, three, let's look at something different. And I brought this up yesterday, and yeah, I still have it on euro dollar. Okay, so you can look at a couple of things. Okay, this line here, as traders are adding to long positions, okay, you get the math here, just adds up all the long positions, but it's also adding up all the short positions. It's adding up bulls versus bears. It's basically like number of trades, or you could look at it as the total amount of money that on the liquidity providers, right? So how many bulls, okay, number of bulls minus number of bears gets you a number. And so what we can see here by looking at numbers, since about November 2nd, we've been slowly accumulating more long positions. Now, since then, this period here, I guess I'll do this in pink. In this period here, we either have less bulls or more bears. Kind of like a commitment of traders report. It's a little slow. There's still more bulls than bears. Okay? But one way you could look at it is, you know, it's not a total volume, and we can get that as well, but it's total volume over time. So you could argue a little bit here that there's just, I mean, there's no right way to say it. I was going to say it's less bullish. It's not true. Is it more bearish? More bearish than before. Okay? But there's just definitely, well, either more bears or less bulls. That's the only way to get the number. Okay? So it's the accumulation of orders. Okay? So I could kind of argue a little bit. It's not quite accurate, but you can think of it this way, that there's less volume. Okay? Yes, that's right, Richard. Yeah. There's a few other things you can use. They do kind of the same thing. So you could add in, what's the other one? So that's on balance. Accumulation distribution. We'll do that one in light green. Okay. And you'll see it's kind of the same thing. It's not dramatically different than the first one I showed you, right? Up, down, up, down. And again, it's adding up bullish positions and bearish positions. So really, look, the volume could be the same if they're offsetting each other. In fact, volume could go up if you have lots of bulls and then a whole bunch of bears get on. Market is neutral sideways, right? And also this could stay sideways. So I kind of look at this like there's less bulls and, right? There's less bulls and maybe more bears. And it's logical because look at the chart, for crying out loud. Like, it's obvious, but to some, maybe it's not obvious. So you could use this and say, well, it looks like it's becoming more bearish. And it could be interpreted that way because there could just be more bears than before. Or if there's less bulls than before, that is also kind of bearish. It's not really bearish, it's profit taking. But nonetheless, you can kind of look at it that way, right? Right, and Richard's like, yeah, well, there's something going on between price and volume. Accumulation and distribution of bulls and bears, right? So you're like, okay, bulls are building up, market goes up, bears are, right? And now it's coming down. Yeah, okay, right? So these two indicators, okay, are basically the same. Slightly different math. Okay. Now you can look at this indicator, okay, money flow index, and it simply makes an index of that type of volume. So this is based on 14 periods. I can change this to 21 periods, but I don't use this indicator. Now you could, and if I did, I would either use 8, okay, or 21, well, whatever. Now I could use a 13 in there, but all right. So anywho, This is different because it's looking at kind of the same data, but only in the last 14 periods, right? But also it's an index. So I forget the math now. What's the math? 100 over 1 minus... I forget the variable that you put in here. But anyways, it's an index. And so you get like 0, you get 100, and it's just kind of doing some basic math here to show you kind of the same thing, right? Where it's bearish now, and you could argue because it's an index, you're indexing. You're doing this as a ratio. So that's probably what the variable is. 1 minus the ratio of bulls and bears, because that's what an index is basically, right? So it's something like that. You guys might know the math. I don't remember the math off the top of my head. 1 minus the what would I call this? Bull-bear ratio. So it's a percentage, right? So anyways, so you could use that information and say, once you get below 20, it's oversold. I don't like to call it that, but that's how you'd probably think of it. And then when it kicks back up, that would be your entry. If the technical's confirmed here, right? Now, that to me is different from the other because not only, like once you make an index and based on a ratio, what do you call that? An oscillator. So now I would treat it basically like an RSI. And you know, for me, you don't buy you don't buy a trade when the RSI is oversold. You buy an RSI when it's rising back into the trade zone. But I also filter this by the overall trend. So you might get a signal like that in a downtrend and I ignore it. But if I get a signal like that in an uptrend, I buy it. Now, I put this in my book in 2008, which means I wrote similar advice back in 2007. Okay, so it's nothing new. I buy dips in an uptrend. So if this says buy a dip, but the dip is in a downtrend, I don't buy it. But if it says buy in an uptrend, then maybe I buy, then I do buy. So this is misused and probably misunderstood. And I'm sure if you wanted to create a strategy, you would line these up somehow where you're like, well, Wayne, as long as we're above this line and I get an entry signal here, maybe I can buy it. Yeah, and I already have this drawn using another analysis, but you could argue that, okay, this would end up being a buy signal. And look, you're doing the same thing with price. So do you need all this? No. But the question is, well, how do you know, how do you know volume? And I could say, well, over the last 24 hours here, nothing's happened on volume. Okay. Now, a third way to add volume to your chart. And by the way, I hope I'm making sense because I obviously haven't prepared a discussion on volume. And I don't use these indicators. So if I'm kind of 80% correct in the way I'm describing it, then I apologize. I'm trying to give you good value, trying to get your time's worth. But these are ways to look at volume. Okay. Another way to look at volume, I think you can just pull it up here, right? Indicators, volumes. Is that going to be right? That's probably something different. No, that's it. Okay. 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 And this is the volume provided by the liquidity partners. So we're going back. I think, Richard, you were the one asking, right? Like, well, how do you use volume and how do you know? I guess somebody else, maybe somebody asked, how do you know? When I'm like, why would you be trading low volume? Well, look at this. High volume, okay? Then we'll go here, average volume, average volume, average volume, average high, right? Average high, average high, average high, average high. We'll call that an average high, okay? And so what has been occurring over the last several days? Now we're at the New York Open. Okay, would you agree that this looks like volume is falling? Is volume waning? Jack, I front run it. Okay. I front run London. So do I ever trade it? Yes. Am I sitting there at the open? No, I'm already in my trade before the open. Okay. Yeah, Richard, that's one way of looking at it. But does it tell you that you're not going to get any volume until Monday? No. But could you take this information and incorporate it somehow into your trading strategy? Yeah, for sure. Okay. Yeah, click the thumbs up, guys. Tell YouTube this is good. Half of you haven't even clicked the thumbs up button. Okay. So there you go, guys. Volume, accumulation and distribution, money flow index, and on-balance volume in a nutshell by Wayne McDonald. Don't forget, if you're in my day trading group or my swing trading group, okay, every live trading group member has access to the stop, look, and correct session today at 2 p.m. All swing trade members, all day trade members have access to that meeting. Please attend. That's at 2 p.m. There is no day trading group tonight at 4. Nope. Okay, there's no live stream tomorrow. There's no day trading group tomorrow. There's nothing on Thursday. The stock market's closed. The bond market's closed. The commodities markets are closed. Banks are closed on Thursday. I believe the stock market's open a half a day, but the bond market on Friday, right? The stock market's open a half a day. I believe the bond market's closed. I think banks are may be closed, maybe not be closed. I don't know, but Friday's not going to be a trading day for me either. So I will not see you guys again until Sunday evening, okay, at 7 p.m., and we'll get the new week set up properly. And we'll probably have busted out of some of these ranges, and that'll be great. And then we got a wonderful December together. I'm already looking forward to December. And remember, the upcoming non-farm payrolls on December 2nd is my 200th non-farm payrolls trading live at FX Street. Okay? Okay? Do you think day trading like David days with alerts? Which David? There were many Davids on earth. Do you think day trading like David with alerts at hourly and daily levels? Oh, you mean from before? Like that? Oh, I see. No, I mean, look, there's more to it than that. Sorry, yeah, David in the chat. No, there's more to it than that. I want you to have this attitude. Learn everything. There's no way at all that you would say, I only look at the hourly chart and then I trade the 5-minute chart. That's partial. That's a small amount of necessary work. Now, what David has found is it's important. Oh my God, there's so much more, but you got to get that. Yeah, you got like going from the hourly to the 5-minute. Yes, to me, that's the last step. But if you're ignoring like the 4-hour, the daily, the fundamentals, seasonality, like, oh my God, you're just scratching in the dirt. It's good, but it's primitive. There's so much more. If I can only get the frog out of the well so the frog can see the beautiful sky. Right? There's so much more. And it's wonderful and it's beautiful. Okay? But you got to know an hourly chart with a 5-minute? Yeah. Is that enough for a career? No. Yeah, but Theta, right? Theta says that's like tunnel vision. Yeah, but it's, I don't know. It's like someone that wants to be a professional golfer and they can drive 300 yards every time. Most of the time they hit the fairway, but they suck with irons. They suck in the sand trap. They suck at putting. And they're like, why do you suck at all these other aspects of golf? Well, because I only practice my driver. You're not a good golfer. Now, people might, wow, man, look at that. David can drive 300 yards and usually hit the fairway. Yeah, but he'll never win a tournament. So your buddies will like you. But you ain't going to make any money on the long term, right? Yeah, Happy Gilmore. Yeah, there you go, Kevin. Right? Like, look, if you truly have a passion for the game of golf, you will learn everything. Even the history. You're like, you know what? I like watching Bobby Jones newsreels just to see Augusta when it was new, to see the persimmon driver he used. Right? It's just, and you read the books, you read the magazines, you watch it on TV, you like to travel with golf clubs, even though it's a hassle, but you love golfing, and everywhere you go, you're like, I wonder what the golfing's like there. And you're like truly a golfer. Do you know? So why the driver only? It's so incomplete. If you were truly a passionate golfer, you wouldn't understand a person like that. I'm like, why? Okay, you don't suck with the driver, but like you suck at golf. I don't need to know that Bobby Jones stuff. No, you don't. I don't need to read the magazines. You don't. I don't need a golf coach and golf lessons. I don't need to like, dude, you're limiting. Okay? So anyways, Monday says, is CMT and CFA worth it? I don't know anything about a CMT. I do know when I first started trading, it was a detriment. People would laugh at you. You would not get hired because you were a CMT. Now, no disrespect to the CMT group, but that was my experience where they're like, professional investors would say, oh my God, you're a technician? Use charts and patterns? You're an idiot. Like literally. So that's likely have changed dramatically. So I'm just saying I don't know anything about it, but why not? Why am I not a CMT? Well, I know a fair amount. If I can just bust out a lesson like this, I know a fair amount. So maybe I should. Yeah, maybe I should. Maybe I'll just be a CMT. Why not? The second thing is CFA worth it? As a Forex trader, no, we don't do finance. We do economics. Now, if you want to work at a bank, okay, even if you are a foreign exchange trader at a bank, bankers hire bankers. Okay. The mindset of a bank is banking. Banking is finance. So I'll tell you what, you have a choice. And I'll show you how easy the choice is. And I get this from when I see and read job openings at banks. And for some reason, I read these things. I don't know why I do, but I do. On a regular basis, I like to look at all right, Goldman Sachs is hiring, convertible arbitrage traders. Okay, cool. What are the requirements? What is their description? Okay. And so if you look at banks, here's what they say. MBA or CFA desired. Desired. You will instantly get shortlisted, which means 100 people are going to apply for the job. 25 of them are going to have an MBA or a CFA. So the other 75 just get thrown into the garbage. So is one of those two things worth it? If you want to work at Goldman Sachs, yes. And if you don't have it, there are plenty of people that do have it. So you're just out. You don't have a chance. So if you want a chance, you need an MBA or a CFA. Okay, great. So what do you do? You take 2 years off and you spend $100,000 and you go get an MBA from a decent school. Not some silly online crap, but a real school. Because you're not going to work at Goldman Sachs with some online certificate of some bullshit MBA, for lack of a better word. You're just not going to work at any firm really, because they're like, it's a bullshit MBA. Okay, whatever. But that would be your choice. It's going to cost you a minimum $100,000, and you have to take 2 years off of work and family. It's pretty expensive. Okay. Choice number 2. At night and on the weekends, at your own leisure, you study for the CFA. Maybe you take a class or two over time, and then you take the first exam and you pass. And then at night and on the weekends and on holidays, you study at night and you study and you maybe take another class and you watch YouTube videos. And in 3, 6, 9 months, whenever you feel ready, you take the exam and you pass. And then you do it a third time because there's 3 exams. And so maybe it takes you 2 years. But now you're doing it part-time, whenever you want, at night, on the weekends, sitting by the pool, you're reading a book, you take a class or two, great. And 2 years later, you've completed your CFA, and your total cost is $5,000. Okay? So study part-time for 2 years at your own leisure, at your own pace, for a total cost of $5,000, or take 2 years off of your life, move away to a school, and spend $100,000 getting an MBA. Which one do you think you would choose? CFA or MBA? Which one would you choose? What's the logical decision? Part-time at your own pace, $5,000, $100,000, full-time, right? And not at your own pace. Obviously, CFA. So somebody is asking here, right? Is CFA worth it? If you want to work at a bank, it's a hell of a lot cheaper. The thing is, here's what happens, obviously. The guy that has the Harvard MBA and a CFA gets hired. But if you want to be shortlisted, you got to have at least one. And if you want a shot, you have to have at least one. So a $5,000 investment is equal to a $100,000 investment. That's the point that I'm trying to make. Dude, get your CFA. Okay? And by the way, if you were going to work for a fund or a bank, if I were me, I would just knock out level 1. Okay? And you're allowed to put level 1 completed CFA. You're not allowed, you don't have a CFA. You're not a CFA. But they'll say CFA desirable. So on your application, you say, I've passed the level 1 CFA exam. And by gosh and by golly, I bet you they throw you in the short pile. Because you're playing the algo, right? Where it's just looking for CFA, CFA, CFA. And you're like, I've passed the level 1 CFA exam. Boom, you're in. Okay? David says, I have a law degree, though not a business degree. You might want to work in compliance. Okay. Can you do a CFA in the UK? Yeah, I believe so. Yeah. Yeah, it's all online. You're right. It's all online. But like, I teach you, like, put it this way. I've taught you guys about the importance of bond prices and bond yields. Okay. And then for some of you that have attended more advanced training, we talk about things like yield curves. And then you can look at, like, oil we've talked about, where you look at July oil prices, October, right? July, August, September, October, November, December. So in July, we were talking about this because I was still doing the oil trading course. And in July, we were talking about the difference in futures prices. There's a curve to this. Okay? So you look at the current price, the future price, the future price, the future price, the future price. Okay? And so from that, you can get a curve. Typically, the curve goes this way. But in July, the curve is going the other way. And that tells us something. So that tells us there's backwardation. And you have to understand what that means. But then if you're a CFA, you would calculate the convexity of that curve. So I can, just like, so I did that in the oil course. In the macroeconomics course, I taught you macroeconomics without the calculus. It's kind of the same thing where I can teach you about backwardation and the differences of futures prices and what they're supposed to be and why, and what it means when they're not what they're supposed to be, how to trade it, but I'm not going to teach you the convexity, how to calculate the convexity of the curve. Do you need to know how to calculate the convexity of the curve? Okay. Thana says, yeah, by the way, we are facing an inversion of the 210. Going back to the worst of 1980. And I think it's, 70 basis points? Yeah. So, do you need to be able to calculate that, the convexity of that yield curve, theta? No. Do you need to understand what it means. Yes. Now, unfortunately, most people misunderstand what it means because they just say, oh, that means recession. Yes and no. Depends on the context of that inverted yield curve. But what it means now is relevant. And what it means now is people feel that we will have high inflation 2 years from now and lower inflation 5 to 10 years from now. And that changes people's investment and the flow of capital. And I've explained that here, and I've explained that in great detail in the day trading group. And we can look at that money flow and the rationale behind why someone would buy the 10-year T-note at 4.25, but not the 2-year as much. So there's a difference between the 2 and the 10. And to me, it's much more interesting, like, why are investors making a rational decision? Like, why are they choosing one over the other? And why now and not as much before? And does it have to do with current inflation levels, future expectation for inflation levels, and expectation for what the Fed is doing? Well, yeah. Okay, so to me, the why question is so much more interesting. The reason I decided not to get a PhD in economics is because it would suck all the love and life out of what I have passion for, because all you'd be doing all day is doing the calculus on everything. And I'm like, I'm not interested in the convexity of the yield curve. I don't really want to be a CFA and analyze it, because to me, I don't give a crap. The convexity of the yield curve, who cares? Let's make money. Let's make money. Come on, honey. Well, you can't make money if you don't understand why. And if I want to know the convexity of the yield curve, I'll hire some guy for 60 grand and he can sit there and go click, click, click on the calculator and come back and say, hey, boss, I crunched all the numbers. And I'm like, good, send me a PDF. Okay. Meanwhile, I need to understand why it's happening. Not what it might mean. No, why are traders making one yield different from the other? What do they know? What do they think they know? How are they trying to make money? And if I understand that, that's how the market works. And now I make money because I understand why. So now you got to look at, well, what's the growth rate? What's the inflation rate? Is this a positive thing? Is this a negative thing? And by positive, negative, I mean on the economy. And therefore, how does that impact the currency? Oh, that's so much better of a question. Growth and inflation. Is it real growth or is it negative growth? Is it real inflation or nominal inflation? And what about the path? Do I need to be able to calculate the slope of the path? I just need to understand the flow. I don't need to know the exact slope, but if I'm like, that makes the slope up, I'm a bull. If that makes the slope down, I'm a bear. Okay? And if I need to calculate the slope, I can either do it myself or hire somebody on Fiverr. Okay? Something like that. So anyways, so most, like Richard says, some of these markets have been inverted for, 6 months. And many people misinterpret that. And they're screaming bloody murder. And they're probably not seeing the market conditions that they expected while they're screaming bloody murder. But it is relevant. But what they're thinking is, what does it mean 6 months from now? They don't realize what the markets are telling you is where inflation's going to be in 5 years. That's what it means. I can look at the 10-year T-note and tell you what inflation is expected to be in 5 years. That's what it means. Okay? Theta says, but all recessions started by this 2-year, 10-year, blah, blah, blah. Yes, but it's not the cause. It's not even the effect. It's like, it's like you saying the speedometer on your car dictates the speed. No, it doesn't. The gas pedal and the brake dictate the speed. The speedometer measures the change of what you're doing down here with your feet. Okay? So it's much more important to watch the feet. Okay? Gas, brake, gas, brake, gas, brake, gas, brake, gas, brake. And that's the Fed. So there's much more to it than that. People describe these things in an oversimplified fashion. Data says Fed moving now with no brakes. No, all brakes. That's what they're doing. Yes, they're raising interest rates. That's the brake pedal. Okay. Richard says, technically, we just, a recession is 2 negative quarters of growth. Yeah, once again, that's kindergarten economics. Yeah, that's not true. But there's so much more interesting information to look at that. So, yes and no. Okay. So anyways, now we're in a recovery. I don't know about that. Why? Because the stock market's been up for the last couple of weeks. That's not fundamental. Okay. That's seasonal. So anyways, thank you for all your wonderful questions. I've taken up more than an hour and a half of your time. That's too long, but I appreciate you. I want you to succeed. Please click the thumbs up button before you leave. If you're new, please subscribe. Okay? Have a wonderful day. Have wonderful holidays. Give your spouse and your kids a hug for me. Okay? Tell them that I'm sorry that I keep you away from them so much. Okay? So, peace on earth. May the pips be with you. May our profits be above average.